Guys, we have the manager of Federal Bank ready with us.
Yes, we do have the Federal Bank management to talk about some of the important policy announcements that came in the last MPC meeting. The RBI last week published a draft regulatory framework for lending against gold. It is proposing 75% LTV ratio along with tighter valuation and purity norms as well as and also more audits. The RBI has also floated a draft paper to expand the scope of co-lending arrangements to all regulated entities. So two separate regulatory sort of paradigms playing out here. To talk about this, we have with us Mr. S. Harsh Dugar, ED of Federal Bank. Mr. Dugar, thanks very much for being with us this morning. So we just wanted to understand what each of these developments could respectively mean for the sector. Let's actually start with co-lending, which is now being made a lot wider. It's not just priority sector, it's being expanded to all sectors and all regulated entities, banks and NBFCs. So from a business standpoint, who stands to gain here? Small banks, smaller NBFCs? I mean, how does it work out?
So good morning and thank you. Yes, the draft guidelines, when you look at it, there has been a couple of changes and that actually will work good for the sector as a whole. If I have to just enumerate what are the changes which will be actually quite beneficial for the sector, the first one, as you rightly mentioned, it includes all asset classes. Earlier, compared to what the focus was on priority sector assets. Second, they've included many more regulated entities, which was not the case earlier. Apart from that, there are three other cases which they have brought in. The minimum retention ratio is no longer there. So you can technically have a co-lending model where there is co-lending together, or it can also be for sourcing and servicing as well. So that actually widens the scope. Other two things which has come up is the default loss guarantee, which was not there earlier, which begins more skin in the game. That DLG of 5% is also going to help both the parties in terms of catering to the segment. And the last of all, which is the CLM2, at this point of time, and what it appears from the draft guidelines, that the CLM2 will not be available as an option, which was there earlier. So these are the five major differences which is there. But if you look at it from the entire perspective, I think it's going to be significantly beneficial in terms of reaching out to the deeper geographies, to those borrowers who are less served by the formal banking system, by the NBFCs and banks coming together. So I think this is going to be a move in the right direction.
Do you see this having any meaningful impact, even if it is a couple of basis points, on overall credit growth? I mean, the last year we were kind of stuck in that zone of around 10-11% system-wide credit. If co-lending takes off in a much wider and deeper manner, given these draft norms, what impact does it have on total credit offtake?
It will have a not a very significant impact because it's still in the initial stages. So it will take some time for credit offtake to pick up if I have to look at the CLM model alone. However, the good part which I have to understand over here is that the deeper geographies, which can be catered by the two kind of lenders who have presence the deeper geographies and people who have deep lending pockets, can actually benefit the borrower as a whole. So that is one significant part. It can bring down the costs for both the parties because it will be a shared arrangement. So from that perspective, it's quite beneficial for the system as a whole.
All right. Hi, Mr. Dugar. Good to see you, and thanks a lot for speaking to us here on CNBC-TV18. I want to ask you about RBI putting the draft paper on gold loans for NBFCs. Now, this provides an opportunity for banks. For you, I think it's close to around early teens, if I'm not mistaken, as a percentage of your total book is towards gold loans. Could you tell us what is the current exposure? And if you see this as an opportunity, will you think of scaling up this business?
Yeah, first of all, let me clarify. There's been a lot of chatter going on regarding that this will impact the banks less compared to NBFCs. So this is, if you look at it from a bank's perspective, it's actually quite beneficial. First, to answer to your question, we have a portfolio of about 30,000 crores plus. It ranges between 12 to 13% of our total lending portfolio is actually gold, and we are the largest private sector player in this segment. And we take pride in saying that we do understand the segment reasonably well. So that is one part of it. Coming to the other part about the draft guidelines, there are two major things which has come up. The draft guidelines seeks to do three major things. One, it has simplified the overall. There were 32 circulars, which is kind of been clubbed into one single draft guideline as it comes out. So it will make things simpler. There's no cross-referencing. There'll be no interpretation issues. So that's one part. The second part, what they have done is they have standardized it, the auction process, the notice period, valuation process, notice to be given, return of jewelry. This is actually good for the sector as a whole, because from the customer's point of view, and please understand that at this point in time, the customer is the ones who does not have access to formal finance, and that's why they typically resort to gold loans, most of it, if you ask me. So it's also essential that their interests are taken care of. There's adequate customer protection, there's transparency, which is what it brings about by making the rules more standardized. That's the second one. The third and the most important one is the harmonization across regulated entities. So you have banks, you have NBFCs, you have other lenders. Over here, it has harmonized the rules and regulations, so there's no regulatory arbitrage or a play between different set of guidelines for different regulated entities. So this is going to be extremely beneficial. So now coming to the 2 points which I was talking about as to why it will benefit the banks. The first part is that it's a question of comparative, not absolute advantage or disadvantage, but comparative advantage or disadvantage. So banks were in any case following many of these guidelines, and more so the LTV to be ensured during the entire tenure of the loan. Some regulated entities were required to maintain LTV at the origination of the loan, whereas banks were to do it during the entire tenure of the loan. Now, this has been harmonized. So from that point of view, it is actually beneficial for banks. That's one.
Correct.
Please
go ahead, sir.
Yeah, the second part is that it is regarding the, they have classified this into 2 categories, consumption purposes and for income generating purposes. And if you ask me, this is actually a very, very positive step initiated by the regulator, mainly because the industry should be encouraged, the sector should be encouraged to take loans for productive income generating purposes. And over here, they widened the scope. Earlier, it was supposed to be given for farm credit and largely agricultural loans. Now, the scope has been widened for any kind of an activity which is income generating in nature. So this has been where LTV rules will not apply. So, except for NBFCs, it's been capped at 75%, but banks don't have this cap as long as the assessment and the repaying capacity is done in a proper manner.
Right. No, that's very, very well explained, Mr. Dugar. Good morning, Prashant here.
Hi, Prashant.
Actually, the sense that this is, of course, all sort of informal, but the indication that we got, actually, a reporter got, was that when this was put out, right? I mean, and if you look at the market reaction, the largest gold loan company, Muthoot, the stock sold off very aggressively. So, but as you said, I mean, and you were also in a state where, I mean, you're based out of a state where gold loans are a big thing, and you know that business, just like Muthoot does or others do, right? And we're based out of Kerala. We've been doing this for many, many decades now. But the sense we got is this is actually more aimed at not the specialized players in this space. It's actually based, these are directed towards banks, actually, who've grown their gold loan portfolios in a very aggressive way. The net impact, as you describe it, may well play out. But do you think that makes sense, logical sense? I thought so.
Prashant, if you ask me, any sharp growth in any sector or by any bank is something which people tend to envy in the bank, also tend to look at it so that there are no hidden skeletons or issues later on which we may face. Now, the good part over here is that gold, while it's a very safe business, it's an operationally intensive business. That's number one. Number two, if malpractices are there or lack of transparency is there, it comes at the cost of the consumer or the borrower, who are typically, like I said, the ones who do not really have access to formal bank finance. So it is essential that these kind of guidelines are standardized, so there is no scope for interpretation or implementation of these guidelines. And that's a very key thing. So that's what the draft circular does. It kind of, like to give an example, the valuation of gold, it's very clearly identified it has to be a 22 carat. It has to be 30 days average or the last day's price, whichever is lower. It's very clear about it. Or where can you take the price from the IBGA or the commodity exchange? So the standardization and uniformity which comes across for the sector is actually, if you ask me, quite a welcome move. The problem is not about guidelines being stringent. The issue is about it being uniform, both in terms of understanding, application, and interpretation. And if that is done, it gives a level playing field to all the players and the people who can have good processes in place and do this in a manner, it's going to be beneficial for them. And that's the reason why we as a bank are quite welcoming.
No, absolutely. That was an important clarification point, Mr. Dugar, that you made, that the LTV norm will be applicable not just at the time of origination of the loan, but throughout the life cycle of the loan. So that perhaps kind of, reins in any kind of excesses that get built in as gold prices fluctuate. So taking forward what you said, give us some sense, say for Federal Bank, out of your total book, how much is gold loans now as a percentage? And in terms of market share, are you confident of winning over market share from some of the NBFCs now that the rules will be absolutely uniform and harmonious across both banks and NBFCs?
Okay, so to your first part, our share in gold as a part of our total advances is about 12 to 13%. And that's where we are at, largely in the last few years. We are quite bullish on this business because we do feel we have a reasonably good understanding. What we are looking at it in terms of these rules coming in, which is something which is being talked about since the last time RBI came on 30th September, that a harmonized set of rules and regulations will actually be beneficial for all the players. And the players who have strengths in that will actually leverage. To answer your question, will we gain share? Most certainly would like to gain share, not just in gold business, but in all other businesses of us as well. But gold in particular, we do feel that we have a strong edge. Our understanding is reasonably deep. We have a reasonably good branch presence, and we have a strong customer base. So, basis for all these things, I think it's a positive for the bank.
Okay. All right, Mr. Dugar, we'll leave it on that note. Thank you very much. Very helpful conversation. Didn't speak too much about the quarterly update, but we'll talk more about earnings and all the usual ratios, I think, once the official numbers are out at the end of Q4. Thank you.
Thank you so much.
We look forward to that as well. Thank you. Thank you very much.